This is Business 330 Business Finance Week 7 lecture video for the week of July 19th through the 25th. And our topic this week is chapters 12 and 13, the cost of capital, how we determine the cost of capital, which is used as the discount rate in the capital budget analysis. Speaking of the capital budget analysis, you now have two assignments or two tasks to do. This week, assignment number 3 is posted, where you are actually putting together a capital budget analysis spreadsheet, and that is due on Sunday, July 25th. That is posted in the assignment 3 file folder. And as we discussed last week, you have the Road Kings Trucks case, which is scheduled for due date of August, I believe, the 15th. And also, we will have a review session scheduled for July 31st on a Saturday that will go over this, but I will talk a little bit about Road Kings also in this lecture. But first, let's determine the cost of capital. We're going to look at a couple of analysis, and let me show you where those analyses are for your reference. Here's our Blackboard file, and as you know, or just to refresh your memory, here is the Road Kings case, which is due in August 8th, but there are extensions available. I think I said the 15th earlier. It's due August 8th. There are the files in both PDF and Word format that you can download and review the work. Again, we'll talk more about this later. And it'll be an APA format paper along with a spreadsheet, a capital budget analysis that we've been working on thus far in the last week or so. Also, in the assignments file folder, you have your assignment number 3, which is to be a spreadsheet file only, for this work. And we looked at a sample of that capital budget analysis in last week's class, and we're looking at another one this week to use as templates in this work. And then if we go to week 7 file folder in Blackboard, you have a spreadsheet right here in week 7 in-class review spreadsheet. This is the spreadsheet that I'll be working on in this lecture video, which you are to review. And also here is a date that you might be interested in. It's a special review session for Road King case to be held on Saturday, July 31st at 9 in the morning. And there's the Zoom link to that session. Click on that link and we will be having a review session at 9 a.m. for about an hour and a half on that Saturday to go over the Road King case and answer any questions students might have on that case. We'll put it together. And we will have that review session on that Saturday, roughly a week before the case is due. At that time, I also will record it. So people who naturally have some other activities on that Saturday, you can watch that video recording later. So a Road King review session on Saturday, July 31st, in addition to our regular classes. Next week's class in week 8, we'll be spending an awful lot of time on the Road King case. So let's take a look at a problem from the textbook to lead us into our discussion this evening. I'm on page 412 and 413 of your textbook, and this is a sample problem that takes into account both chapters 12 and chapter 13. It's determining the cost of capital, the weighted average cost of capital, and I supplied a couple videos for you in our introduction video, in our YouTube playlist, and in our Blackboard file folder that define the weighted average cost of capital. This company, the Buildwell Construction Company, is trying to find their cost of capital. Remember, the weighted average cost of capital is a combination of the cost of equity and the cost of debt. And they give you all the parameters in this. And this is the chapter 12 is discussing the cost of equity, the capital asset pricing model used in this problem. And chapter 13 is to combine that with the after-tax cost of debt to determine the weighted average cost of capital. So let's take a look at our sample spreadsheet, our in-class review spreadsheet on how to do this problem number 4 on page 412 and 413. Okay, here is that problem 4 in chapter 13, set up in a spreadsheet file format, very similar to the sample problem we're going to look at in a few minutes, and very similar to assignment number 3, and very similar to the Road Kings case. The key part of it is, first of all, find the variables. What are the key variables to use in your calculation? Number 2, how to apply them in a formula to get the desired number effect, and also kind of understand what's going on here. What we're trying to do is what does it cost on a given on this given date? What is the cost of money for this company based on their capital structure? And if in the problem 4, the capital structure is given to you as the debt position of the company is 30%. So if the debt position of the company is 30%, the equity position's got to be 70%. It has to total 100. Remember, assets equals liabilities plus equity. So the right-hand side of the accounting equation has to total 100% of the 100% of assets on the left-hand side. So first of all, we now know the capital structure of this problem number 4, 30% debt, 70% equity. That's going to drive the weight of the cost of this money that we're going to determine now. It's given in the problem that the company's tax rate is 21%, and the interest rate on that debt that make up the 30% is 5%. So now we can calculate the after-tax cost of debt, whereas it's given as the interest rate is going to be multiplied times 1 minus the tax rate. In other words, we get a tax deduction. Interest expense is a tax deduction. So if the company's tax rate is 21% in this problem, it's different for every business, then you take 1 minus 21% and multiply that, which is 79%, times 0.5, 0.05, 5%. So if I put that in the equation, equals 0.05 times 1 minus 0.21. That's the tax rate. 3.95%. So we get to deduct on our taxes roughly about 1.05% of that interest expense as a tax deduction. So our true after-tax cost of debt is 3.95. And notice what happens here in this spreadsheet. This 3.95 now goes down to here, and I take the weight of the capital structure, 30%, times that rate, 3.95, and I get the weighted after-tax cost of debt, 1.19%. Now let's determine the cost of equity. Here are the parameters given in the problem for that. The risk-free interest rate is 4%. The market premium rate, which is the average return on the stock market, is 8%. And this firm's beta is 0.9. That's the risk in the market of this company over the last 4 years, 16 rolling quarters. That's what beta is. Beta is a comparison. It's a standard deviation analysis of the return of a company versus the average return in the market. If we are looking at the market betas, let me put this here, the market betas would be 0 for risk-free interest rate and 1.0 for market return. In other words, these are the average, these are the betas for risk-free. If there's no risk, then there's no beta, 0 risk. And for the market premium, which is the average rate of return in the stock market, mainly given by the Standard & Poor's 500 return, its average is 1. Well, this company has a comparison to that of 0.9, so their risk is even less than the market. And thus you'll see a cheaper cost of equity compared to the market return of 8%. We'll see that in just a minute. So the beta is a statistical calculation that will always be given to you. Remember in our portfolio work of the last assignment or the last discussion post, I asked you to find the beta of your companies. That's what that is. The beta is the risk compared to the market of your firm in your portfolio to the market. And if your beta is greater than 1, then the company is a little bit riskier, more riskier than the average return in the market. If your beta is less than 1, then it's a little bit less riskier in the market. That's what that means, and that's what Chapter 12 is all about. So now we take this information and apply it to what is called the capital asset pricing model, taking the risk-free rate plus the market premium times the beta of the company. So in this case, our risk-free rate is 4%. Our market premium is 8%, and we multiply that 8% times the beta of this company, 0.9, and now we'll get our capital asset pricing model. So let's do that. Equals, and I'll put this in parentheses, 0.04 plus parentheses 0.08 times 0.9, that's the beta. Let's put that in another parentheses there. And here we go, 11.2%. In other words, it's taking the risk, let me make sure I did that right, it doesn't look right. 4% plus, yep, 11.2, that's correct. So with that, the interest rate or the market premium is taken times the beta 0.9, which is 7.2%, add 4% to that, and you'll see our return is 11.2%. Now notice what I did. I took that 11.2% down here, and we take the equity portion of 70% times that, and we get our weighted cost of equity of 7.84%. So now we add the after-tax weighted cost of debt, 1.19, to the cost of equity, 7.84, and we get our WACC, our discount rate, 9.03%, and that's our cost of capital. This is what Chapter 13 is all about. It's taking your after-tax cost of debt and weighting it to what portion of the company is financed by debt, in this case, 30%. And then it's taking the cost of equity, which is a relationship of the firm's credit or risk to the market risk of zero risk and average risk, 11.2%, and weights that. And so on this given date, at this period of time, on average, this company is paying a little bit over 9% for their money. And that will be used as a discount rate in any problem or any capital return analysis that this company will be doing. So that's a perfect template for weighted average cost of capital. You have to understand the terms and then put them into the equations to determine that number of 9.03%. Now let's take a look at another tab in this week 7 capital budget template review spreadsheet. We've done problem 4 in Chapter 13 here. Now we're doing another weighted average cost of capital. See if you can use this spreadsheet and that you download and see if you can do it yourself. But here are the specifics for this one. Notice it's set up exactly the same way as our problem out of Chapter 13. But in this case, the numbers are a little different. The debt to assets relationship is 60%. If debt is 60% of assets, and then in this problem, equity is 40%. This company's tax rate is 25%. Their interest rate on this debt is 9%. The risk-free rate, or with a beta of 0, is 2% in this problem. The market rate of return is 10%, and the firm's beta is 1.35, a little bit riskier. Notice here, this is where Professor Hasse can pull a fast one. In this problem, Chapter 13, it was given to you as the market premium. Here, it's given to you as the market rate of return. The definition of market premium is the market rate of return minus the risk-free rate. That's the definition of market premium. In Chapter 13, that calculation is already done for you, 8%. But here, we just give you the market rate of return. So we're going to have to do the market premium, which will be 10% minus the risk-free rate, or 8%. Just be on the wise for that. That's where I can get you. So let's determine these numbers. Okay. Oh, let's get rid of this. There we go. Okay. So after tax cost of debt, we're paying 9% on our debt. Multiply that by 1 minus the tax rate of 0.25. And we get 6.75% as our average cost of debt, our after-tax cost of debt. Put that down here as this weighted. And now we come up with 60% of the 6.75 for our weighted cost of debt, 4.05. Our cost of equity is the risk-free rate, 2%, plus the market premium. Now, remember what I just said, the market rate of return is 10, so the market premium is 10% minus 2, the risk-free rate, which is 8%, times 1.35, so equals 2% risk-free rate plus the market premium of 10 minus 2 was 0.08 times the beta 1.35 of this company, and we get 12.8%, a little bit higher, 12.8%. So put that 12.8% here. There's our weighted cost of equity. Add those two together to get our discount rate, or our WACC for this particular problem, of 9.17%. All right. Same way we did it here, just the numbers are a little bit different. And the terminology, market rate of return here, market premium in the prior problem, we have to take that market rate of return to determine the market premium. This is explained in chapter 12, but it's a little confusing. So that's why I wanted to spend a little bit of time on that. So now we take this 9.17% and go to this analysis in this tab. This will be our discount rate, 9.17%, to be used in this problem. Just like we did last week, we're going to do a capital budget return analysis for this company of an investment of 4 years only, $340,000, to determine the NPV, IRR, profitability index, and payback of this capital budget analysis. Remember last week it was a little bit longer, at a discount rate of 9.17%, which is the WACC that we just calculated for this company. Okay, this template, along with the one you did last week, is a great template to use for assignment 3 and for your Road Kings case. So let's build this template. First of all, our investment is $340,000, cash going out, so it's negative. That's our investment, okay? Our sales are, we're selling 2,000 units a year at a selling price of $1,200. So equals 2,000 units times $1,200. There's our revenue for year 1. And that is going to have an inflated rate of 3%. So now we're going to take this times 1.03. That's our inflation rate, 3%. We're going to increase our sales by 3% after year 1. And now I'll just slide that over to year 4. And there's our total revenues for the 4 years. 2,000 units a year times $1,200 per selling price per unit. And then we inflate it after year 1 by our inflation rate of 3%, which is about what the economy is now, about maybe even a little higher, 3%. Our variable costs. Variable costs. We're, again, 2,000 units being produced and sold. Our variable cost rate is $900 per unit. So equals 2,000 units times $900. There's our total variable costs for year 1. This also is going to be inflated by 3% times 1.03. There's our inflated amount. Slide that over. And there's our total variable costs for our project. Our fixed costs are not per unit, they're $400,000. So $400,000 here, but that also is going to be inflated at 3%. Even though it's fixed, it still goes up in price. And there's the 3% inflation, and spread that out over the 4 years life. The 4-year life is the depreciable life of this particular asset. Our depreciation is $85,000 a year. We're depreciating 85,000 a year, which is fully depreciating that 340,000 over the life of the project. So what is our earnings before taxes? All right. We're going to take our sales and minus out variable costs, fixed costs, and depreciation. And there's our earnings before taxes. We're going to copy that all the way to year 4, doing that same formula over the 4 years. And there's our earnings before taxes. We're going to take that amount times our tax rate. There's our tax rate. We take 25% of the earnings. And now let's slide that over. There's our taxes paid. And notice my next formula is already in there. It's subtracting out the taxes from the earnings operating profits. And there's our net accounting income, $372,544. That's our net accounting income in this project. Now we have to add back in a couple additional cash flows as we discussed last week in this analysis. First of all, our salvage value is $30,000 to be received in the final year, $30,000. But since we fully depreciated the asset over its life, that $30,000 is a gain. So we're going to have to pay tax on that times 1 minus the tax rate of 0.25. So we get to keep 75% of that salvage gain, $22,500. Oop, I put that in the wrong column. That should be right here. Sorry. There we go. Get that out of there. That's the salvage value, $22,500. Makes sense? Let's add back in our depreciation. The $85,000 is a non-cash expense, so we're going to add that bit back in as positive cash flow in the every year for 4 years. And then we have our working capital. We talked about this last week, 11% of next year's sale. So 11% of 2.4 million is negative $264,000 of working capital. And that's going to be delted every year as the revenue goes up. And then we add it all back in by taking 11% of year 4 and add that's positive cash flow. Always working capital is positive cash flow in the final year of a project because the net effect will be 0. So now we have our net cash flow. We're spending $604,000 in year 0 today. The investment in the asset and the working capital needed to get that asset operating. We're generating almost $1 million in project cash flow, net income, plus or minus salvage, depreciation, and working capital. So now we take these 4 years of cash flow and discount them, called the discounted cash flow, back to today, year 0, at our WACC, 9.17%. Formula, function, financial, net present value. The interest rate is 9.17%. That's our WACC. And the values are year 1 through 4. Year 1 through 4. Hit OK. And there's our discounted cash flow. That $999,000 of project cash flow discounted back to today at our cost of capital, 9.17% equals our discounted cash flow. So our net present value is the difference between our discounted cash flow and the net cash we're spending in year 0. we're generating $167,707 in positive cash flow off this investment, taking into account revenues, expenses, depreciation, taxes, cost of money. We're making money today. Our internal rate of return is, what is this in a percent? Formula, function, financial, internal rate of return. We've done this before. And we just paint in values year 0 through year 4, including year 0, and we come up with 19.08%. So we like this. We're making positive money, and our return is much higher than our cost of money. Our cost of money is 9%. Our return is 19%. That's a good thing. Our profitability index is the ratio of the discounted cash flow to the investment. So equals discounted cash flow divided by negative the investment. And our profitability index is above 1.28. That's a good thing too. You want your profitability index to be a greater than 1. That means you're making money. How long does it take us to pay back this $604,000? Well, $604,000 plus the year 1 cash flow that's left to be paid back. Our year, what's met balance left, plus the year 2 cash flow. We still have $273 to pay back. And now we'll just slide this over. And if you can see, notice at the end of year 3, we still have $101,000 to pay back. But naturally, our cash flow in year 4 is $496. So we're paying it back sometime during year 4. What is that sometime? So we just take a percentage of what's left in year 3 as a percent of year 4 cash flow. So I'll take equals negative this number and divide it by the year 4 cash flow, 123.2 years. So 20% into the 4th year when we're paying back the $604,000, generating a net gain of $395,044. So notice the payback is in non-discounted numbers. All the rest of this information is in discounted numbers. Our return in dollars, our return in percent, our return in a ratio, our return in years. Very nice. And if I was a manager of this project, we're generating a return, we're paying it back, I would say this is a go. Let's go with this investment because we're returning our money and making an adequate return on that investment. This is what you're going to be doing in assignment 3. This is what you're doing as your original analysis, and then you're going to write about it in the Road King case. So we'll practice this week in assignment number 3. Your job in assignment 3 is to put the information given to you in assignment 3 into this format to determine this information. You now have 2 samples of these spreadsheets, last week's and this week's. And here's our assignment number 3, what you're doing this week. All right. You're asked to prepare, determine the weighted average cost of capital, and perform a capital budget analysis, exactly what we just did, and find the net present value, the internal rate of return, the profitability index, and the payback of this analysis, and determine whether this is a go or no-go to go ahead with this project. Is this project, in your eyes, after this analysis, a go for investment? If it doesn't meet your expectations or profitability, then it's a no-go. So you have to calculate the cost of debt. The cost of money. The WACC is debt is 60%, equity is 40%. The interest rate on a debt is 6.5%. The firm's tax rate for this calculation is 22%. The firm's beta is 1.5. The risk-free rate is 1.15, and the market return rate is 8.5. I repeat, the market return rate is 8.5. Put those together, and there's your WACC, calculation number one, just like we just did. And then I give you a project that has 5 years in length, an investment of 750,000. Here's the yearly depreciation. Here's the salvage value. Here's the working capital percentage. Here's the inflation rate. And for this project, the tax rate is 30%. Note, the tax to determine WACC is different than the project's tax rate. Why? Probably this project is being in another part of the country or another part of the world where the tax rate is different than where you're raising the capital. You're selling 40,000 units a year. There's your selling price per unit. There's your variable cost, $30, and there's your fixed cost, 175,000, with an inflation rate of 3% after year one. Put all those together and tell me whether this project is a go or no go. And I want to see your spreadsheets with the formulas and the calculations, just like we just did in our class prior this evening and last week. So you have your templates to do that. Okay, well, hopefully some of you in this last week have downloaded the 4 main files of the Road King case to review them. After you complete assignment 3, you now have all the necessary skills and discipline to complete this assignment due August 8th. Again, it's a spreadsheet and an APA paper format. And again, in next week's class, next week's lecture, we will review this in a little bit more detail, but I want you again to make sure you read these and get a feel for what you have to do in this case study. This is part of our assessment of this course. It's very important to continue on in your business program to be able to do this. Once you get to your capstone class, you'll be having to do the same thing in your capstone class, your last class in your business program. So again, here's the assessment instrument under giving the details of the Road King's case. Here are the 6 questions you have to answer in your paper. Excuse this due date, that's incorrect. Here are the exhibits with all the various information you need for this case. Make sure you read them. Here's the project deliverables. How I would like it in what format, font, what you need to have available. That's the project deliverables. Then you have the introduction, which gives you a pecking order of what you have to go over. We'll go over this in specifics in next week's class. And also a rubric of how I will grade this work. That's important for you to know and understand what I'll be looking for in my grade assessment of this work. So make sure you read all this, and we will review it in detail next week. And also, some of you might want to start on this. Here's one of the advantages of this program or this work. Once you get your spreadsheets going, you're going to have to do 2 spreadsheets within one spreadsheet, 2 tabs, one for each product. There's 2 products you're reviewing here. You can send me the drafts and we can review them. I will not review your paper, but I will review your drafted spreadsheets to make sure you got everything in order and everything looks fine to continue on in your writing. So as you complete these spreadsheets, you can send them to me for review. That's one of the reasons we're going to have that review session on Saturday, July 31st, to give you one last opportunity to review the spreadsheets prior to you putting the paper together and answering those 6 questions that are asked for you to write on in the case. So there we are. Week 7 has begun, and this is our last week of talking about capital budgeting and cost of capital. We're wrapping it up this week with assignment number 3, and now you have all the necessary material to begin the Road King Trucks case. The Road King's case will be discussion of our week number 8, along with corporate finance, and also we will have that review session on July 31st. So hopefully you all have a good week. Good luck on your assignment number 3. Any questions, you know where to find me. And I'll see you all next week, and have a great week and stay healthy. Adios, everybody.